The OBBBA law is the most significant tax law that's happened to business owners in almost a decade. But remember, these benefits aren't automatic. You have to do the work. And it's not just about the taxes. It's about designing your business and your life in a manner that helps you live a great life. Hey friends, welcome back to Real Personal Finance. I'm Scott Frank, founder of Stone Steps Financial, and your guide to making money feel a little less intimidating. This episode is for all of you business owners. Landlords, consultants, freelancers, board members, anyone with pass-through income. Today's episode's about the One Big Beautiful Bill, otherwise known as OBBBA. The new tax law freed up real money for you to spend on things that actually matter to you. Last time we focused on major changes for retirees. Today we're going to dive into how this bill can help you as a business owner. Now, we are going to get technical this episode, but don't zone out. The moves that exist within this bill could help you shape how quickly you see financial freedom. Today we're going to talk about 6 provisions in the bill that could help you as a business owner. These aren't short-term gimmicks. Most are here to stay. Ready to get rolling? Let's do it. Let's start with probably the biggest permanent shift for business owners. If I offered you 20% more of your business income every year, would you take it? That's exactly what qualified business income does. So here's the gist. If your business is a partnership, an S Corp, or a sole proprietor, anything other than a C Corp, you can knock 20% right off the top of your qualifying business income for taxes. All right, let's look at an example. So let's say you make $100,000 from rentals every year. With QBI, you can deduct 20% of that, or $20,000, and bring it down your income to $80,000. Well, removing that $20,000, if you're in the 32% tax bracket, that saves you $6,400. What could you do with that $6,400? Save more to make work optional, maybe take a better trip, help your family, do a home improvement project, whatever you want, right? So the biggest win for this QBI deduction is, one, it's first permanent. It was supposed to expire at the end of 2025, and that would have taken away, that free, in a sense, $6,400 that we just talked about in the example would have gone away. It would have been paid by a taxpayer. This is now permanent. So permanent meaning until the tax law is changed by Congress. There's also higher phase-out limits. So there are limits to these things. The deduction is now phased out at $75,000 if you're single, $150,000 if you're a couple. That was up from $50,000 and $100,000 in the old tax law. And there's also a new $400 minimum deduction. So if you're active in your business and you have up to $1,000 of income, you get a minimum $400 deduction, which is pretty cool. So just a little heads up though, for those of you like me, if you're in a service business, so think accounting, health, consulting, finance, if you're in any of those types of things, and check with your accountant, you do hit phase out limits on the amount of income. So once you hit over 191,000, if you're single, it phases out, and 383,000, it singles out if you're filing jointly. But they are much better numbers than before. So again, they went up just as the other ones did. Is QBI for you if you have rentals, if you have consulting income, if you have board fees? Pretty much anyone who's in business should qualify for QBI. You may be phased out if you have certain income parameters in your service business, but double check with your accountant and just make sure that you're taking advantage of it. All right, the next provision. Let me paint a picture. What if instead of writing off new equipment or property over years, you could write off the whole thing today? That's 100% bonus depreciation. Now, this is huge for anyone investing in business property, such as computers, furniture, equipment, or real estate, if you know about cost aggregation, which is basically breaking down the property component parts into smaller bits so you can write them off faster. More deduction means more cash flow in your pocket today, right? More money to put back in your business or in your life. In the old rule, the bonus phase out was down to 40% for 2025, With the new rule, you get 100% bonus right away. It's permanent. It's not going away until Congress changes it. I would have to say that because they'll eventually change it. And for property placed in service on or after January 19th, 2025. Let's look at a real example. So let's say you buy a rental property with a $400,000 basis. Basis just meaning what's the building itself worth, not the land. Normal depreciation for that building would be $14,500 a year. It's a 27.5-year schedule. But if you do cost segregation, where you go see, well, hey, the roof actually depreciates faster than the building and the doors and the windows and yada, yada, yada. And you bring all those things together and you see that, oh, some of those things qualify for this bonus deduction. So I can go ahead and do $150,000 or more in the first year. And if I'm in a 35% tax rate, that could save me $50,000 plus in the first year. That's real money. It's not just on paper, right? We get to keep that. We don't have to pay it to the government. We get to do something else with it. Now, a caveat for bonus depreciation, most states don't play by these federal rules. So check with your CPA to see what's the best way for you to handle depreciation. All right, so next up, the third provision we're going to talk about is enhanced QSBS. What does that even mean? So for my wealth building friends in the startup world or in small business, qualified small business stock. The old rule for qualified small business stock, this is section 1202 of the tax code. If you start a business and it's a C Corp and you hold it for more than 5 years and it was under $50 million of valuation when you started the hold period and like jump through all the hoops and all the hoopla and you sell it, up to $10 million of your gain can be tax-free federally. Well, under the new rule, which started July 4th, 2025, any company that started QSBS the day after, so July 4th or after, now after a couple things changed. One, the dollar amount for the valuation to start the clock went higher. So it used to be 50 million, and now their valuation is 75 million or less. The next thing that changed was the amount that we get to have as gain went up to 15 million from 10 million. So now we get a $15 million gain. Awesome. And then the next thing is it's not just a cliff of 5 years, you get it or don't get it. It's now a progression of a cliff, which starts in 3 years. So 3 years after you've the company's been formed, you've been holding it, or you've been holding the stock since 3 years, you get 50% exclusion. 4 years, you get 75% exclusion. At 5 years, you get 100% exclusion. Now, what does this even mean? What this means is, let's say that you invest in something, maybe $500,000 into a company, and in the end, you get to sell it for $15.5 million. So $15 million gain on that would be tax-free federally. And at a 23.8% tax federally, that's the highest tax rate we can have for long-term capital gains currently, that'd be a savings of $3,570,000 in your pocket. It didn't go to Uncle Sam. Pretty sweet deal. If you're in the QSBS space, an angel investor, an entrepreneur, definitely worth looking at this more and seeing, one, are companies that you've invested in the past set for QSBS, and two, are you? And if you want to, go ahead and look at that. If you're an entrepreneur looking at that, you're going to want to look at the idea of how are we currently set up with the tax structure? Does it make sense to flip to be a C Corp? If we flip to a C Corp, how much extra do we pay in taxes year over year to get us to that exit? Because you don't necessarily just get to keep that $3,570,000 I gave you an example of. You're going to probably pay a little bit more in taxes along the way because C Corps don't tax as efficiently as, say, an S Corp. All right, so the fourth provision is enhanced business interest deduction. So, let's talk about a change that can really boost your cash flow, especially if you're using loans to build your business or invest in real estate. So here's how it works. Whenever you borrow money, say like for equipment or for rental property or to grow your business, you pay interest on that money that you've borrowed. And normally you can deduct that interest on your taxes. That's great because it lets you lower your tax bill and keeps more money working for you, and you can invest it and grow, have better employees, do all that fun stuff. But recently they tightened the rules Congress made it so that you can only deduct up to 30% of your adjusted taxable income. And to make it tougher, they took depreciation and amortization out of the formula. Basically, that just means they took out a section where we were depreciating, say that bonus depreciation earlier, where we were, doing that deduction on the building. They were taking that away, which made it so that it was just harder and harder to reach that goal and take the full deduction on the interest. The new law fixes that. Now when figuring out how much interest you can deduct, depreciation and amortization are back in. And that means the income number is going to be higher. So then the amount you can deduct should also be higher. So, as far as what it means for you, let's say that you had a $500,000 loan for a rental at 6%. That's $30,000 of annual interest. Before, you might have been able to only deduct a portion of that. But now you should be able to deduct more of it now that depreciation and amortization are back in. Ultimately what this means is you have more money in your pocket to focus on running your business as best you can. The fifth element we're going to look at is domestic R&D expensing getting restored. So thinking, research and development, like that's just for tech people, right? No, not so. If you improve products, if you develop software, if you're doing market research, this can apply to you. Check in with your accountant. Previously you had to amortize those costs over 5 years, but now you can fully deduct them up front for domestic research and development starting in 2025. And a bonus, if you're a small business, gross receipts of $31 million or less, which that could be many of you, filing amended returns and get immediate refunds on research and development costs from 2022 to 2024. So that's like real cash flow in your pocket, right? That could really help lower some taxes owed and get some money back in your coffers. All right, so the final provision we're going to look at is Section 179 increase. So Section 179 is a deduction limit that's now at $2.5 million and phases out starting at $4 million. Section 179 lets you expense business property instantly, and many states allow it, even if they don't allow bonus depreciation. So think of it similar to what's going on with bonus depreciation, but it's an immediate expense, and most states go along with the same rule. Of course, double check with your accountant to see who does what with which state and which is better for you, bonus depreciation or Section 179, to see what you should do. Quick wins and next steps. First up, qualified business income. Review your eligibility. Restructure if you can get more, right? Look at this through the lens of having a chat with your accountant and seeing like, hey, are we set up properly to get the most we can out of QBI and tax savings on our tax return? Bonus depreciation. Go ahead and take a look at it. If you have things that you're looking at buying in the near term, make sure that they're being managed appropriately. Tie that in with Section 179 and see which makes the most sense for us. Which should we use? Next from there, if you have qualified small business stock, if that's something you've been thinking about, if you're planning on selling your business in the next 5 to 7, 10 years, and you have currently are an LLC or an S Corp, anything other than a C Corp, and you have a big valuation that you could sell for in the future, could be worth looking at the math of, does it make sense to become a C Corp and go for Section 1202 and get that tax-free gain when you sell? From there, R&D. Go ahead and look at the R&D and see, like, is there anything that we have done from an R&D standpoint that we could be writing off faster? And ultimately, realize that these things don't live in a vacuum. They're operating based on the life that you're living and trying to build. Most small business owners, their business is them and they are their business. So what do you ultimately want to get out of the business, and what do you want to give to the business? Make sure that they're aligned, and then let's use the tax code to help you optimize as best we can. The OBBB law is the most significant tax law that's happened to business owners in almost a decade. Many of these things are permanent now. A qualified business income, bonus depreciation, qualified small business stock could potentially be game changers for you if used correctly. But remember, these benefits aren't automatic. You have to do the work. And it's not just about the taxes. It's about designing your business and your life in a manner that helps you live a great life. If you want help with your big picture, or you want to know how much do I need to retire, Feel free to click below to take the quiz. If you found this of value today, please share it. Someone you know probably needs it too. Personal finance doesn't need to be confusing. It starts with you. Align your time, your money, your energy, and your talent with a life that has you jumping out of bed in the morning. Thanks for tuning in. See you next time.